Hello and welcome to the Currency Exchange, NatWest Markets FX podcast, where we help to break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Brian Daingerfield, who's their US head of G10 FX strategy. And FX markets did not disappoint in terms of volatility and big moves. So overnight, in the Japanese morning, we had the yen touching its weakest level in 34 years. Before unexpectedly dropping over 5 big figures. I mean, it looks a lot like intervention, but Brian, was it actually FX intervention or do we even know?
Yeah, thanks very much for having me, Eimear. I mean, this looks like intervention for sure. We've definitely had a couple of experiences in dollar yen recently where you had big down moves, these sort of phantom down moves that were quickly reversed. And the scale of those moves were a lot smaller and the duration of those moves was a lot shorter lived, right? In this case, what you saw in the overnight session in Tokyo on Monday morning, as we record here in the US on Monday morning US time, was you saw big down moves in dollar yen during a fairly illiquid period. It happens to be a holiday in Tokyo today, the overnight session last night, I should say. Saw big sustained down moves in dollar yen, as you mentioned. The pair traded above 160 during the Tokyo morning, and then it quickly reverted back closer to 155. And so the scale of the move lower in dollar yen is much larger, and the persistence of the move is much clearer that we're trading closer to the bottom end of its range of the day than instead of a quick reversion back higher. And so this certainly looks like intervention. The officials in Japan were quite cagey on whether or not this was intervention. They opted neither to confirm nor deny that this was intervention. We will get a couple of clues coming up in relatively soon as we sort of parse the data to get a sense of this intervention. I mean, the Ministry of Finance does release intervention statistics each month. The next release is actually tomorrow in Japan. They release on April 30th for the prior month. Unfortunately, that data probably doesn't cover moves that happened on Monday morning simply because of the time difference between when the end of the month, they release the monthly intervention stats, but that usually doesn't cover the final couple of days of each month. So it's possible we might have to wait all the way until the end of May for official confirmation from the Ministry of Finance, the total intervention statistics for the month that included today's moves in dollar yen. And so we might have to wait over a month for actual confirmation from the Ministry of Finance. I think it's pretty clear that they've wanted to have a little bit of a shroud of secrecy over this move. I think they want the market to have that feeling that they could be in the market at any time, that they might have been in, they might not have been in, and sort of give that market a sense of uncertainty around this move. Other things that we'll be able to watch is the Ministry of Finance and Bank of Japan's the FX reserve statistics. Those come out, the monthly read on those come out at the beginning of each month. And so in the first week or so of May, there isn't an exact timing of release. There will be a release of the total FX reserves held by the Bank of Japan on behalf of the Ministry of Finance. And so those statistics will give us a sense if there was a big change in those statistics. I think it'd be pretty clear that was a change in statistics that was a result of using those funds for intervention. Another one we could watch is the weekly data from the Fed, because a lot of these securities holdings, whether they be the deposits, the shorter term holdings, or the longer term treasury holdings, they're likely being held at the Fed, whether that be in the FEMA reverse repo facility or in the custody holdings. So those data come out each week from the Fed. And so each Thursday afternoon in the US, we might get a sense of whether or not there were big swings in these official holdings that are held at the Fed. That could be a sign that the BOJ has been moving money around from those facilities in order to fund interventions. And so, those facilities, I should say, from the Fed, or those totals are not delineated by central bank. It's all the central banks that hold funds with the Fed. So the Bank of Japan certainly not the only one that would be in those buckets, but I think it'd be pretty clear if you saw big moves in those holdings this week, that could be a sign of the scale of intervention. I'd say last point on intervention is that all of these official statistics are going to be coming out. There will be plenty of potential tea leaf reading that we could be doing in markets. But of course, there's also the potential for media leaks and media speculation. There's certainly the possibility that well before we get any of the official data, that there are media leaks to the extent of this suspected FX intervention. But man, this certainly looks like FX intervention. It seems like the officials in Japan have finally reached a point where they had seen enough in terms of persisting yen weakness, and looks like they decided to pull the trigger overnight in Tokyo hours.
And I mean, these dramatic moves that we've seen in dollar yen, they really came on the heels of Friday's Bank of Japan meeting. And in the aftermath, yen definitely traded weaker against the dollar. Why was it the market was so disappointed and they took this meeting as relatively dovish?
Yeah, and that's exactly right. I mean, this is, if you look back to the 2022 Bank of Japan intervention in September of 2022, one of the features of that intervention, the first time they intervened in the market in 2022, in the period, they did a couple of interventions further in October of that year. The September 2022 intervention came on the heels of a Bank of Japan meeting that was interpreted quite dovishly, and a market reaction where the yen weakness extended to, at that point, multi-year highs. Very similar this time around, where it was a market reaction to the Bank of Japan decision, a dovish reaction that appears to have spurred a reaction by the Ministry of Finance to step in and defend the yen. So what was this decision and why did it impact the currency so much? I think in this case, it is the absence of a decision, and that's what impacted the yen. So all of the market discussion heading into this decision was about not necessarily whether or not the Bank of Japan would hike their policy interest rate at this meeting, but more, how do they internalize the weakness in yen into their policy decision? So the yen has weakened, since the Bank of Japan delivered their historic rate hike at their March meeting. The currency has weakened persistently and significantly against the dollar. Now, the weakness in the currency does feed into the Bank of Japan's inflation forecasts. Weaker currency does mean potentially higher inflation coming from imported goods, for example. And it could feed into expectations for inflation as well, that if individuals in Japan see imported prices moving higher, that could lead to higher expectations for inflation in the Japanese economy that comes from a weaker currency. And so the market was really eyeing up this decision from the Bank of Japan, not necessarily for a big change, but whether or not it was going to be a moment where the Bank of Japan signals clearly to the market that the weakness in the yen is starting to cause knock-on effects on inflation that will require more hawkish policy outcomes down the road. So market trying to find a sense of where is the Bank of Japan's reaction function to the weakness in the yen that we have seen. If the Bank of Japan had come out on last week, delivered a significant change in guidance, very clearly flagged the weakness in the yen as something that may require a policy response, and perhaps made some changes to its quantitative easing program, its bond buying schedule, to maybe reflect some of that extra concern over the currency, I think that might have given the market a sense that the changes in the dynamics in the FX markets were leading to a more hawkish evolution of Bank of Japan policy down the road, that the reaction function was weaker yen is leading to more hawkish policy outcomes, and that further weakness in the yen would lead to more hawkish outcomes down the road, right? So that is something that could have potentially quelled this this feedback loop from weaker yen from Bank of Japan policy into weaker yen. That Bank of Japan policy is very dovish, and so that leads to a weak yen. But if the Bank of Japan had come out last week and said, we are taking the FX weakness into account, and that's something that's going to lead us to be more hawkish down the road, then the market would have to think that further yen weakness from current levels is going to lead to more hawkish policy down the road, and that acts as a bit of a counterweight against the yen weakness that we've seen. All of that potential signaling from the Bank of Japan, none of that happened. In fact, we had almost the exact opposite, where the Bank of Japan came out and its decision was firmly unchanged. Their policy statement was extremely short. Their outlook report did not include any specific study of the yen weakness and its potential implications, or at least the summary of the outlook report, their bigger forecast profile. And the changes in their inflation forecast were not meaningful in the way that might signal that the Bank of Japan is much more worried about the currency weakness that we have seen as it comes to policy. There were really two major outcomes that could have happened. Either the Bank of Japan expressed a clear change in reaction function to the currency via changes in their policy and changes to their guidance, or they give us basically no signal that the currency weakness is having an impact on their policy deliberations. And the market could take one of two messages away from the Bank of Japan. In the former scenario where a change was made, the market's assessment may have been that the yen is changing the reaction function from the Bank of Japan, and that yen weakness as a result is something that could result in more clear Bank of Japan hawkish policy, and something that maybe is something to consider when thinking about shorting the currency or remaining short the yen. In the inverse, I think the Bank of Japan gave the market effectively a green light to continue being short the yen, because they basically, the signal to the market from those forecasts and from that decision was the weakness in the yen that we have gotten is not sufficient, at least at these levels, to warrant a bigger change in policy. Now, there's very good reasons why the Bank of Japan should take the approach that they did. The biggest one is that yen weakness is not necessarily the kind of inflation that they want to achieve. When the Bank of Japan is looking to have durable, domestically driven inflation, as sort of, when they're looking for a virtuous cycle, they want higher inflation. They've been in deflation for 30 years. They've been trying to escape it. They've had this ultra easy policy. Yen weakness really causes externally driven inflation coming through. All of the inflation that comes from a weaker yen, or I should say most of it, comes from the external sector. It's because the cost of goods that Japanese companies and individuals are buying that are imported are all more expensive. All the inflation comes from external sources. I think what the Bank of Japan wants instead is for domestically driven inflation. They're looking for stronger demand, stronger economic growth, and with it, higher wages. And that's why wages in the Shunto wage rounds, when we were thinking about the March meeting, were so important to that decision back in March to make the historic decision to hike the interest rate, which they did at the time. They were looking very, very clearly at internally driven, domestically driven inflation. What the yen weakness brings is the external inflation and not necessarily having a big impact on these internal deliberations. So I think there's plenty of reasons why the BOJ is not necessarily changing their reaction function because of a weaker currency. But that was what was on the line at the meeting last week, was if they make a big hawkish change, it would be a clear signal that the Bank of Japan is becoming more uncomfortable with the changes in the currency. A decision to not make any changes is implicitly a signal to the market that the BOJ is not ready to internalize that, or at least they're not particularly fussed about the weakness in the currency in how they're setting policy. And I think that was effectively a green light for the currency to weaken, which it did significantly. And I think that was why the MOF felt that they needed to step in at this point, was that the BOJ effectively gave the market a green light. And I think the MOF wanted to maybe flash a yellow light, if not a red light, to the market. And so the MOF really, I think, stepping in here to almost treat the symptom of policy divergence that the BOJ policy has allowed to continue, rather than necessarily make a big change in terms of fundamentals.
Yeah, and I guess kind of waiting to step in on a Japanese bank holiday, you get more bang from your buck if you're going to intervene. So definitely a smart decision from their point of view. I guess the really big thing here is this the turning point? Do you see continuing yen strength from this, or do you think dollar yen could sustainably trade above 160? That is a new trading range that we've just broken range on.
Look, I think FX intervention has its limits, and its ability to change the fundamental outlook is very, very minimal, right? And I think that applies here as well, that FX intervention is very effective in a couple of scenarios. It's probably most effective when it comes to positioning and momentum. So when positioning is all one way, and there were clearly signs, I think, that positioning was very clearly short in the market, that market was very short of yen. The yen is a popular currency to be short for carry trades. Carry trades have generally performed very well throughout a lot of this year so far, and that's continued for the most part. And you have this monetary policy divergence between the Fed and the Bank of Japan, where the Fed has been moving more clearly in a hawkish direction because the data have been pushing in that direction. Whereas the BOJ, as I just mentioned in my long comment there, they have been moving in the dovish direction and have stayed in that dovish lane despite the currency weakness that they have seen. It did not result in that change in reaction function or that signal that I think the market had been looking for. And so from a fundamental perspective, I think there are still reasons for the yen to stay weak, whether it be because of the BOJ policy remaining very dovish and them not really giving a signal that that would change just because of the currency. You also have the dollar on the other side, where U.S. economic activity has surprised pretty consistently to the top side. We're going to get another big slug of data in the week ahead, including the employment report here in the U.S. Coming out this Friday. The CPI surprised definitively to the top side in the US, same with the retail sales that we got here in the US in the month of April. So there are reasons why the dollar is strengthening globally and why the yen is weakening that are fundamental in nature, and that those are things that are not changed by Ministry of Finance policy. That intervening in the currency doesn't necessarily stop monetary policy divergence from continuing. Where I think FX intervention can be effective is when positioning is all one way, as I mentioned, and momentum is all one way. And I think the momentum one is, as we look back on this move and this intervention, which looks like we very likely got on Monday morning in Tokyo hours, I think if we can almost do a post-mortem on this as we look back on these interventions, one of the things that I think will be very clear is that momentum may have been a big driver of this decision to intervene. That it sort of felt like that this move from, call it the high 140s in early March and sort of the aftermath of some weaker data, all the way through this move where we pushed up through 160. It certainly felt like the momentum was very clearly one way, towards dollar strength and yen weakness. And there really didn't seem to be a lot of two-way price action. That you had a couple of times, a couple of risk-off sort of scenarios where, remember during this time we had the escalation in tensions between Israel and Iran, something that we discussed quite a bit of depth on previous editions of Currency Exchange, Eimear. We had periods where you had some pretty significant risk-off moments where yen strengthened in the initial impulse, but those moves were fleeting. You had a couple of times when the yen strengthened, but those moves were very fleeting, and the general direction of travel was pretty clear. The momentum was all pushing in the same direction towards higher dollar yen. If you look at things like the relative strength index RSI, if you look at things like those stochastics, if you look at our own assessment of what CTA trend followers might be doing based on moving averages, almost all of that was pointing very, very clearly in the heavily dollar long yen short direction from a momentum perspective. And I think the MOF looked at the market and said, there is all the momentum directionally is one way, and intervention can help maybe create a little bit more of a two-way environment in dollar yen. And so I think from a positioning and momentum perspective, intervention can be effective. The problem is there an argument for intervention to continue past a one-off period? And the argument there is not necessarily very good. I mean, you do have, is the Ministry of Finance going to be in the market every day intervening? Are they willing to do that? Do they have the political will to do that? How would the US respond, for example? I think it's very important that we follow and we monitor the reaction from the US Treasury, from Treasury Secretary Yellen, from the US administration. How much leeway does the Ministry of Finance have, do they think they have, to intervene consistently to put downward pressure on the dollar yen exchange rate? Or is this more of a one-off type of move? And the one-off moves especially, I don't think they change that fundamental outlook. And so, there's clearly still risks for dollar yen to the top side. And a lot of those relate to the dollar, right? We are going to have this big week ahead. We are going to have the Fed coming up later this week. So those risks are very still clearly there. I think this move was effective in some ways in terms of positioning momentum. From a fundamental perspective, probably isn't enough to make a durable change to dollar yen.
I think that's such a great point about kind of the political elements of this, right? That one-off intervention could be okay, but you do it on a sustained basis and you risk kind of looking like you're trying to get an export advantage among your peers. So certainly something to keep in mind how the US responds to it. Brian, that is about all we have time for today. So thank you so much for joining me. And if you did like the podcast, please do click like and remember to subscribe so you get the latest episode first. Thanks again.